The bottom is about to fall out of the U.S. housing market. Home prices are going to go down by a lot more over the next several months because the leading indicators of home buyer demand in America, they have plummeted over the last several weeks. The National Association of Realtors, they just reported that existing home sales in America in September were around 4.7 million. Well, mortgage purchase applications, which are a forward-looking indicator of home sales, have just crashed by even more, suggesting that we could see by November or December the lowest level of home buyer demand in America we've seen since the spring of 2008. And prices, which have gone down by a lot in certain cities already, are going to go down by even more.
The calculations for a home buyer have altered significantly as a result of the more than doubling in mortgage rates since the beginning of this year. The interest mortgage payment and monthly principal on the median priced property is $930 more than a year earlier, representing a 73% rise. Buying a house is costlier now than it has been in decades when you consider rising mortgage rates, rising property prices, and slower salary growth. Goldman Sachs economists predict that home values will fall by 5 to 10% from their high in June. According to Wells Fargo, national median single-family house prices will fall 5.5% year over year by the end of 2023.
We take a look at this map showing the decline in home values in America, according to Zillow. We can see so far, most of the decline in prices has been on the western half of America, which you could see is in orange. Metros like Austin and Phoenix and Vegas and San Francisco have had the biggest declines, while the southeast and parts of the Midwest and the Northeast have done better. However, that ends over the next couple months, everyone. The Northeast and the Southeast are now being dragged into this crash as well, particularly Florida. The home buyer demand metrics in Florida have dropped off the table. For instance, pending home sales in Naples, Florida are down 73% year over year, a 73% reduction in buyer demand. Meanwhile, pending home sales in Jacksonville, which wasn't affected by the hurricane, are down 51% year over year. Florida delusion, it's over. The investors and the second home buyers are not rushing into this state anymore, and that's going to mean big price declines in Florida are coming over the next several months. Another southeast market that started to take a turn for the worst is Nashville. In Nashville, the pending sales have plummeted to down 40% year over year. And what's scary in Nashville and many of these other housing markets in America is that not only is the for sale housing demand declining, we also have rental demand in a free fall. We have a double-barreled housing crash occurring where housing demand on both ends is at the lowest level in 3 decades. Take a look at this article from RealPage that manages over 10 million apartment units. They are reporting that the third quarter of 2022 in America was the worst leasing demand for apartments in nearly 30 years, which is shocking, everyone, because the conventional wisdom suggests that a decline in demand to purchase homes means that rental demand should increase, but that is not what we're seeing. We are seeing housing demand plummet at all levels, which is a signal that the recession is much worse than people understand right now. Because housing demand, that's telling you how the economy is really doing. And if housing demand for buying and renting is at multi-decade lows, that shows that the economy is in the tank and that this low unemployment rate of 3.5% is not going to last for long. The other important thing to understand about this decline in the rental market is what it suggests about inflation. Because a big part of the inflation calculation is rent. Over 1/3 of the government reported CPI inflation comes from rental inflation. So if the rental demand is tanking and rents are going down in America, which they are, that means that inflation will go down into the future over the next, let's say, 3 to 6 months, which means interest and mortgage rates are likely to go down as well. So I want you all to be paying close attention to this rental market because it has huge implications about what's going on in the economy and with interest rates and Federal Reserve policy.
Oh my gosh, home sales just absolutely got reamed. We were expecting a month-over-month decline of 4% for pending home sales. We actually got a negative 10% decline in September, way worse than expected. Sales are now down 31% year over year. And this is where a lot of folks who talk about the housing market say, hey, but inventory is still in short supply. Yes, maybe. Inventory might be at much lower levels than what we've previously seen, but if you start actually selling less of these homes, the metric of months supply of homes extends. That's because if, let's say in a normal market, you have 200 homes on the market, but now you have 100 homes on the market, you have half the supply. But if usually 10 sell a month, that would be 10 months of supply. But if now only 5 are selling a month, you have 20 months of supply. So the fact that less homes are selling is a concern for how much home prices could continue to fall. And mortgage rates for the 30-year fixed are sitting at about 7.2%. That's a solid 4.5% greater than where we sat in December of last year, which reduces about 45% of buyer purchasing power. But there's a problem with mortgages. And that's the potential that the Federal Reserve starts selling off mortgage-backed securities. See, unlike treasuries where they just roll them off, mortgage-backed securities might actually begin to be sold by the Federal Reserve. And this is going to create a very, very real risk for real estate. The 10-year Treasury yield could begin to fall early next year, but mortgage rates could potentially stay high if the Federal Reserve starts selling mortgage bonds, which means that we will see prices for bonds on mortgages come down and mortgage bonds actually increase. That means you see what's known as a wider spread between risk-free treasuries and mortgage rates. And when credit spreads rise, you could actually be in a situation where the 10-year trends down while mortgage rates continue to trend up. And the Fed, while they've been talking about selling mortgage-backed securities, they have not actually undertaken. When that occurs, there could be some real fears that mortgage rates continue to maintain higher levels, and we see more pressure on the real estate market. Take a look here. This shows us that with caps on redemptions on treasuries and agency mortgage-backed securities doubling in September, the pace of the balance sheet runoff was set to increase in the coming months. The markets for treasury securities and agency mortgage-backed securities continue to function, although liquidity conditions in both markets remain low. Low liquidity conditions is not good. That means you have less buyers for treasuries and mortgage-backed securities. Less buyers means higher rates. And listen to this. We're starting to get this talk. A couple of participants remarked that after the process of balance sheet reduction was well underway, it would be appropriate for the committee to consider the sale of mortgage-backed securities in order to enable suitable progress to their longer-term goals. Notice, folks, this was the report of the minutes that came out just a few weeks ago from the Fed Reserve meeting of September 20th. So they're already having murmurings of dumping mortgage-backed securities. Dump mortgage-backed securities, and what do you end up with? You end up with more pain for the housing market.
The median price of an existing single-family house is predicted by Wells Fargo analysts to be $385,000 this year, up 7.8% from last year, although the growth will be far less than the 19% annual increase projected in 2021. The median home price is expected to drop to $364,000, a 5.5% decrease from this year, according to experts. By the end of 2024, the median price is expected to have increased 3.3% to $376,000, as prices are expected to bounce back and increase once again in 2024.